Suppose you inherit a gold mine today. A geological report sitting in a filing cabinet confirms the deposit holds 3 million ounces of gold. With prices at $4,000 an ounce, you are technically looking at $12 billion worth of metal. But that valuation is an illusion. Modern mining operations almost never find treasure chests or pure veins. The metal is locked inside billions of tons of solid rock, distributed at concentrations so thin you could sift through the dirt for a lifetime and never see a single flake. To get 1 ounce of gold, a piece roughly the size of a coin, a typical open-pit mine might need to blast, haul, and chemically process up to 300 tons of rock. This ratio is the ore grade, and it is the single most important number in mining. At a grade of 1 gram per ton, a mine struggles to survive on thin margins. At 3 grams, the operation is doing well. But finding 30 grams of gold in every ton of rock is a rare event that can turn a small company into a billion-dollar business overnight. The value of a mine is not determined by the total amount of gold in the ground. It is determined by the unit economics of extracting a specific grade of ore from the rock. Defining that resource requires exploration drilling, which is incredibly expensive. A single hole can cost $400 per meter to drill. Companies often spend tens of millions of dollars on drilling programs that ultimately find nothing usable. Even a successful discovery faces a permitting process that can last 8 years. During this time, you are paying for environmental studies, legal teams, and community liaisons while earning zero revenue. Construction almost always requires building a self-sufficient city in a remote location. You must build heavy-duty roads, high-capacity power generation, and housing for hundreds of workers. Capital budgets for these projects frequently exceed $1 billion. The processing plant itself is a massive capital expense. Specifically, the grinding mills, rotating cylinders that crush rock into powder, are so energy-intensive they often consume half of the entire mine's electrical power. Because of these staggering upfront costs, most mines begin their lives heavily leveraged with debt. This high interest burden makes the operation extremely sensitive to even minor technical delays or geological surprises. Once production begins, the costs become permanent. A large open-pit mine runs a fleet of trucks, carrying hundreds of tons of rock per load, operating 24 hours a day. Maintenance is a massive line item. One tire for these trucks can cost $40,000, and a full replacement set for a single vehicle can reach $450,000. For a large fleet, the tire budget alone would fund a medium-sized company. Fuel creates another layer of risk. A single mining truck burns nearly 1 million gallons of diesel a year. If oil prices spike, your operating costs rise automatically, regardless of what is happening to the price of gold. The processing plant requires constant upkeep. The steel balls that crush the ore wear down and must be replaced daily, while the chemicals used in gold recovery are consumed in every cycle. Labor is often the largest recurring expense. Remote mines pay high premiums to fly specialized workers in and out on charter aircraft, while specialized wages in the industry have recently risen by over 8% in a single year. This chart shows the standard benchmark for the sector, the All-In Sustaining Cost, or AISC. This metric starts with the gold price and subtracts direct mining expenses, equipment maintenance, corporate overhead, and the eventual cost of closing the mine to find the true cost of producing 1 ounce. Profitability in this industry is determined by the spread between the global market price and a mine's AISC. If that margin disappears, the operation becomes a liability. This creates a dangerous economic trap. A mine's expenses, like debt service, labor contracts, and equipment payments, are fixed and rigid. However, its revenue is tied to a volatile global market that the company cannot influence. This graph illustrates the risk. At $4,000 an ounce, even a high-cost mine earns a profit. But if the gold price plummets toward historical lows of $1,200, that same mine faces immediate bankruptcy. Industry titans are not immune to this math. Barrick Gold once took a $5 billion loss on a single project due to cost overruns, while Rubicon Minerals saw its valuation collapse after new data revealed their geological models were wrong. When the gold is gone, the liability remains. Companies are legally required to restore the land, which involves removing infrastructure and ensuring that toxic waste rock facilities are permanently capped and monitored for decades. Past failures, like the $4 billion taxpayer-funded cleanup at the Giant Mine, have changed the rules. Modern operators must now post massive financial bonds up front to guarantee they can cover the costs of environmental closure. Managing a modern gold mine is a high-wire economic equation. Success requires keeping that equation balanced for decades against volatile prices, rising costs, and geological surprises. If you can do that, you might get rich, but the process is far more complicated than simply finding gold in the dirt.